Okay, good afternoon, everyone. Thank you so much for taking the time. First off, most important, we know how busy each and every one of you are, especially on a middle of a Thursday afternoon, right? So it's 2 p.m. Eastern time here, and I know we have a lot of agents dialed in from all over the country, even from California and Hawaii. So we really appreciate you spending this afternoon with us. The goal is that every single one of you walks away with a nugget, right? With something that you can use in your practice to move the needle, especially in the annuity space. And you're going to see the latest Insurance Newsnet report and some data that your mind will be blown after you read these stats, because the annuity part of the industry is up by 20-30%. Okay, and that's talking about fourth quarter 2023 over 22. It's insane. So my point is, if you're specialized and focused in the life space, or you're a annuity veteran, or maybe brand new to the annuity world, we're going to have a little something for every single one of you today. And the reason why is we have our annuity team. So Josh is here, Ashley, RJ, and we are breaking down the top products, the top carriers, and strategies of 2024 and what we are seeing that's working best with our agents and their clients, and we're sharing all of this with you today. So again, lots of nuggets. Make sure you take down notes. Use that Q&A pane. So if you look at the GoToWebinar little panel there, it's like a little rectangle. You can minimize or expand that, but we want to hear from you, please. Okay, good, bad, indifferent. We want to hear from every single agent that's dialed in, even if it's a, hey, you guys are doing great, or you guys are horrible, or you should do this different, or whatever. Questions as we go, jump in. We're going to get to each and every agent. And if we don't get to you in real time, we'll get to you as soon as we wrap up today. Also, every one of you will receive a thank you email. Okay, before we're done today, you'll have this in your inbox, and we will include how to get started, some of the platforms we're going to jump into, and then, of course, the co-op lead programs. Everything will be at your fingertips, even the new Vegas incentive flyer. So some really, really neat stuff. Let's jump right in here. And, what we wanted to do today, before I jump into the latest Insurance Newsnet article and these amazing stats, is we wanted to share with you, we see all over the industry, from carriers, from IMOs, they'll specialize in a certain company, and they'll have a VP talking for an hour about how great their carrier and their products are, and typically, yes, they are great, okay, but they also have a vested interest in that specific carrier or those products. And the reason why we did this today, specifically with Josh, RJ, and Ashley, was we wanted to look at this from like an outsider's point of view, right? And not be so focused on one or two carriers, but to look at all of the carriers industry wide. So that's why we're super excited about this presentation, and that's why we wanted to dive in. Andrew, if we can go to the first slide, that would be great. So what we're going to do, I don't know if you're aware, my friend Paul Feldman owns Insurance Newsnet since day one. In fact, we have a podcast where I sat down with him for an hour, and he just published this latest article, and this is based on the Wink reports, also LIMRA and NALBA statistics, and I'm just going to talk about some of the highlights here. And this is what I was saying earlier about being insane stats and numbers in the annuity space. So real fast, annuity sales set more records in quarter four of 23. In fact, annuity premium breaks $100 billion. This is up 33.1% compared to the previous quarter, and up over 32% compared to the same period last year. Okay, here's the great one. Listen to this. Index annuity sales for the fourth quarter were $27.9 billion, up just under 20% when compared to the previous quarter, and up just over 29% when compared to the same period last year. Okay, folks, I don't know about you, but we have to keep our eyes peeled in this space. We have to make sure that we're building out this department like no other. We have to make sure we're spending our dollars, our resources, and building out the annuity division to make it bigger and better for you all. Why? Because 24 is here, and this annuity space is going to be bigger and better than ever. We have to make sure our agents are geared up and they have the best leads, support, service, carriers, products, all the above. That's why this isn't a joke anymore. This isn't just, hey, I'm going to focus on life and yeah, I'll sell an annuity or two if it ever comes up, or I'll refer that business out elsewhere. No, now is the time. You got to be focused, okay? And we're talking about monster commissions, okay? Underwriting turnaround time, if it's a clean case, okay, happens typically within a week. So no exams, no APSs. This is 1, 2, 3 stuff. And with all the latest riders, with living benefit riders, with income riders, we have some great strategies that tie in perfectly to these products and concepts that you're going to love. By the way, even if you've never sold an annuity case before, no problem. Lean on Josh and RJ and Ashley. Okay, I mean, they will do everything except speak to your client. Okay, so please, very important. You need to know that. And the next slide is the proof in the pudding that tells you exactly that. And the reason why is because we wanted to share the latest agent testimonials. You are our client at the end of the day. We don't sell on a retail level, right? We wholesale 100% to you all, to our agents, agencies. So this means the world. Top left corner. These are all fresh, by the way, that came in on Facebook or through email. And if you leave a comment, a testimonial review, we'll send you the IUL prospecting book or Mary Reed's latest book on us. Top left corner, RJ is an excellent member of your company. He is the consummate professional. Angela's service and follow up with the status of my cases has been excellent. When I ask a question, she always responds quickly. Gary, Christy, I would like to thank you for the heads up about Liberty Bankers. Because of your guidance, I was able to make the sale. You're a true rock star. Rick, Sam, Gary, again, this means the world. Okay, this is everything to each and every team member here at Levinson and Associates. By the way, 4 states now. We have our employees spread out over 4 states. And again, they are focused on helping you, our agent. So very important. Let's keep moving. So real fast, this is our first expo ever, okay? 52 years. It's our first expo ever where we are just as focused on the annuity side as we are on the life side, okay? It's always been about 80-20, 70-30, 90-10, where we were more heavily weighted on the life insurance side compared to annuity. Not anymore. Now, right down the line, 50-50. As you can see, top right corner, every single red square there, that's a life and annuity carrier. We have annuity presentations now. In fact, a few of the presentations are 100% focused on annuities, okay? Sales ideas, not just product info and how great the ratings are, okay? No, we're going to talk about everything related, again, to you moving the needle in the annuity space. Make sure you are registered. We're capped at 300. We already have over 200 registrations in today, okay? We're capped at 300 because of the fire code. Make sure you get in your RSVP. We're going to have the entire team there. This is, we call it Reimagine. Like I said, this isn't our first rodeo, our first expo, but it's the first time ever where we have drawn a line down the middle and said, we're going to focus on life and we're going to focus on annuity, and it's going to be 50-50, okay? So very important that you all are there. You're there to learn and walk away with new nuggets. Let's keep moving forward. So real fast, all of the carriers that we work with, they all have great incentive programs, you know, and you can win extra gift cards. They have gas cards, Amazon cards, you name it, which is all great. And you should leverage these incentives, okay? But what we wanted to do is show our agents we're not just like every other IMO out there. Yes, we have the carrier incentives, but we also have our own in-house incentives above and beyond, which really gives you a great opportunity to earn extra marketing dollars, okay? We have a complimentary dinner for 2 at Ruth Chris Steakhouse, a wine membership from Cooper's Hawk, I think most of the states have a Cooper's Hawk, but if not, we give the equivalent in a gift card. So either way, let's look at the right-hand side. The annuity, this is called our MAP program, Marketing Allowance Program. As you can see, starting at just 150,000 in FIA premium, you win. You're in. Okay, we're not just waving a flag saying, "Hey, as soon as you write 5 to 10 million, you're in. We give you a free orphan lead." No, no. Starting at just 150,000 in premium, you get 250 bucks marketing allowance or an Apple Watch, and then it just goes up from there. Let's keep moving forward. Our latest contest. This is a big one, and I hope you're sitting down for this because everyone now wants to go to Vegas. Okay, they have. I don't know if you've been recently, but they have this new sphere that is mind blowing. It's unbelievable. Something you have to check out. Okay, so here's what we did. We made this very achievable for everyone. Okay, starting at just 500,000 in FIA premium, 2 nights, 3 days on us. 750,000, same thing, but we also pay for round trip airfare for two. And then at a million, okay, write this one down because I know you're going to make this. 5 days, 4 nights at the 5-star Aria Hotel. We pay for round trip airfare, again, 4 nights plus a $500 gift card for meals, for whatever you want to use it for. A helicopter ride, you can go in dune buggies in the desert, you name it. We don't care. We want you to go enjoy on our nickel. Okay, and again, this is above and beyond the carrier incentive. So run with this stuff, okay, on top of the best service in the world. Let's keep moving forward. Insure Me Now Direct. By the way, I'm almost done. And then Ashley, RJ, and Josh are going to take the wheel. So real fast, Insure Me Now Direct is another unbelievable platform you should be using. You should be literally running on autopilot today. And the reason why, check out the latest carriers products. We even have final expense now. This is 100% direct to consumer, just like Amazon. Okay. You go on Amazon, you buy 22 different things for the house, the office, the car, the dogs, the kids, whatever. Same exact concept, but for life insurance, for supplemental products. Okay, we even have Banner now up to $2 million instant decision, okay, with zero agent involvement, or you can be involved and do this on a tablet, on your smartphone. We don't care, okay, and we believe in this platform so much, right? We're putting our money where our mouth is. We're saying, hey, even write your own life, write your own policy on the platform. We're going to give you $100 cash with your first application on the platform. And listen to this, Banner Life, up to $2 million, instant decision. I just found out from the president, the head of distribution. This is a little secret I'm not supposed to share yet, but I'm going to share it anyway. I heard up to $5 million that's coming in 2024, instant decision. Okay? I'll say no more. Let's keep moving forward. It's going to be a big one. I'm telling you right now. Top annuity team and carrier portfolio here at Levinson. We're very proud of our team. You saw some of those testimonials. We stand behind this between Ashley, RJ, and Josh. Over 65 years of annuity experience in the brokerage space, in the carrier world. Okay, they've been on both sides, and I'm very proud to call them our annuity team here at Levinson and Associates. So if you haven't had a chance to speak to them, pick up the phone, introduce yourself, and we would be more than happy to hold your hand, like I said, every step of the way until you get an application approved in force and everyone's happy. Top annuity companies, left-hand side. What you're going to notice here, there's a lot of companies. Each one has a certain niche in the space. And again, we're here to hold your hand and show you the way. You also need to have peace of mind knowing that you're not in one of these MLM groups. You're not 28 and a half layers or levels below the GA, who's below the MGA, who's below the IMO 4, who's below the IMO. No, it's you, us, and the company. Okay, very important. Service-wise, you need to know that. Ask these questions. Also, when it comes to a release, as long as there's no chargebacks, okay, no debt, there's no risk on our end for a chargeback, we give you a release in writing. Okay, if it's not for you, whatever the case is, we never hold you captive here at Levinson on both sides, life and annuity. Okay, let's move into our feature presentation of the day. I'm very excited about this. So, real fast, we are going to jump into my 100-foot introduction here. We have Ashley, our annuity VP, RJ, our life and annuity brokerage manager, and of course, Josh Hoffman, our life and annuity brokerage manager. They're each going to take a portion of the presentation. We're going to start this off with Ashley, and she's going to dive in, sit back, relax, and take those notes and walk away with nuggets. Ashley?
Thank you, Bill. Thanks for going over that. So today we're going to go over some of our top annuity products of 2023 and current year. So we'll just get into that next. So one of the first things that all agents should do when they meet with a client, whether it's a brand new client or an existing client, is try to find out what type of annuity product would best fit the client's needs. So there's going to be three things that you need to ask your client to determine what type of annuity product that you should be looking into for your client. One, do they want income? Do they need guaranteed income for retirement planning? Or two, is this just, are they moving their money for accumulation purposes where maybe they're not old enough to retire and plan for retire, or maybe they are, but this is just a different bucket of money where all they care about is accumulation, protecting their principal funds? Or do they want to leave this money to maybe their kids or their grandkids and planning for that? So those are the three things that you need to ask your clients up front to find out what type of annuity product works for them. And that will help you identify what direction you need to go in determining what type of annuity product is best for your client. All right, and some of the topics we're going to cover today are annuity rider options and understanding how they work, our top guaranteed income products, also different types of riders that maybe you really haven't heard of before, you're not familiar with, how long-term care riders and doublers work, and some of our top accumulation products that do not have any riders or fees at all. All right, so the first thing I want to get started in is how does an income account product work? So whenever you're thinking about an income product, you have to think of it as there's two different buckets. So the first bucket we have is the accumulation value. The second bucket is going to be the income account value. And this will help you understand what goes into the buckets and what comes out, so you can explain it to your clients a little bit better, because a lot of these questions will come up. So the first bucket is your accumulation bucket, or also known as your ACV. That is where let's say a client has $200,000, they're going to put $200,000 in their accumulated value. That is also going to be matched up on bucket number 2 in the income account value. So it's going to go into both buckets, the premium amounts. Next, if the product offers a premium bonus, that is going to go to the accumulation value. Now, whenever you're looking at an income product, you have to make sure you understand the bonus, because some products only offer a bonus on the income account value and not the actual accumulation value. So most of the income products that we see, the bonus does not go to the premium. It doesn't go to the accumulation value, bucket number 1. So you really have to know that so you understand where that premium bonus goes to. So today we're going to actually go over a product that offers a bonus on the accumulation and the income account value. So this would come into play here. You would have your premium bonus under the accumulation value and also matched on the income account value. Next, on bucket 1, I'm sorry, can you go back to the previous slide? Sorry, the next one down, third row. The accumulated value, that is where your earned interest is going to go. So whether you have your funds, your client's funds allocated to the fixed account, right now we have products paying as much as 9.25% on a fixed interest rate in year one. Or you have the money allocated in index allocations. Whatever your client earns in interest, that goes to the accumulation value. That does not go to the income account value at all. And how it works on the income account value, bucket 2, the guaranteed roll-up rate that is offered for the product, that is going to go into the IAV. That goes into the IAV every year, or until your client takes out their income. And then once they start taking out their income, they stop earning that annual roll-up rate. And on the next slide, we're going to go over what actually comes out of the accumulation value and income account value. So if the client takes 10% withdrawals out, that actually comes out of the income account value. If you could go back to that last slide. I'm sorry, I'm still on that slide there. Thank you. So on the left-hand side, dark blue section, anytime your client takes a penalty-free withdrawal, which might be a 10% penalty-free withdrawal, that comes out of the accumulation value. That actually is refactored on the income account value. So if your client says, I want to wait 5 years before I start taking income, but in year 2, they call you and say, hey, something happened. I need a new roof. I need to take money out of my annuity. Well, when they take out that penalty-free withdrawal, that is going to refactor their income account value at that time, because they're going to go in and refactor that deduction, which is actually going to bring their income account value down as well. And then on the next line, what you'll see is the income rider fee. The income rider fee always comes out of the accumulation value, which is the same bucket where the earned interest is credited. So the income rider fee always comes out of the accumulation value. And on the next line, you'll see once your client starts taking that income out, that is actually deducted from bucket 1 and bucket 2. And then also the death benefit value, that comes out of the accumulation value. So if you have a client that passes away and let's say their income account value has been growing for a while, they have $500,000 in their income account value, but their accumulation value is $300,000, they are not going to get that $500 on the income account value. That is not the death benefit amount. That is solely only for the lifetime income. So they will get that accumulated value of the lower amount, which would be the $300,000. And on this slide, we're going to go over one of our top guaranteed annuity products. This one is with Sentinel Security Life. It's called the Summit Bonus. One thing that I really like about this product is this product offers a 15% premium bonus and income account value bonus. So that goes back to what I was just explaining. This product is offering $15,000 to the client's accumulation value and matching it to their income account value. So this client, in this situation, they put in $200,000. Day one, they got $30,000. Day one up front to their accumulation value and their income account value. Now, this product offers an annual roll-up rate of 7.25% per year, guaranteed. It goes to the income account value, bucket number 2. It does not matter if, let's say, year one, they only earn 2% from the S&P 500. It does not matter how the market performs, what their indexes do, if they earn anything. No matter what, they are going to get 7.25% every single year, which you can see here on the screen. They purchase this at age 65. with $200,000, they immediately get $30,000, which shows in their income base, which is their income account value. And then they're going to get 7.25% every single year for up to 10 years. Now, after year 10, let's say your client says, I'm still going to work for a couple more years. I don't want to take that income yet. It would then renew for years 11 through 20 at 2%. So instead of getting that 7.25%, years 11 through 20, they would earn 2% roll-up rate on the income account value. Now, here you can see on the left-hand side where each year 7.25% is credited to the income account value, which brings the income base up, and the payout rate is according to your client's age. The older they get, the higher payout rate. So if this client said, after 1 year, I want to go ahead and take the income. So at age 66, their income account value has grown to $246,675. That means in 1 year, they received that 15% bonus plus the 7.25%, all to their income account value, which brought that up to $246,000 only in 1 year. And they are factoring 6.72% of that income base would give them an annual lifetime payment of $16,577. It is locked in. It's not going down. It's not going up. They are going to get that payment for the rest of their life. It doesn't matter if they live 30 more years. They're still going to get that $16,577, even once their accumulation value hits zero, because they've been taking income out for 30 years, let's say, they are still going to earn that $16,577 no matter what. They cannot outlive that money. And then you can see each year that they leave that money in there, it's going to continue to go up 7.25%. So for instance, at age 70, if they decided to take out that income, it would then grow to $23,499 per year, every single year for the rest of their life. Now, moving on to the next slide, we're going to go over a different guaranteed income product. So here we have F&G. I know a lot of you are familiar with that carrier. This product is called the Safe Income Advantage. Now, the difference on this product is this product does not give an accumulation value bonus, so it doesn't give a premium bonus. It does not give an income account value bonus. However, their payout factors are very high, so that's how they still beat other carriers that give a high bonus. Now, please do not get sidetracked when you're dealing with annuities and you see really high bonuses when it comes to income products. You cannot only solely go off of those bonuses, because we see some carriers that offer a 30% bonus, but guess what? Their payout factors are extremely low. So this product has higher payout factors. It's still going to beat, let's say, 30 other income products. Because it has higher payout factors, they don't have to offer a bonus. They don't need to, because they're paying out a higher percentage of the client's income account value. So in this scenario here, we have a client age 65. They're going to retire after 5 years at age 70. They're going to put $200,000 into the Safe Income Advantage, and they want to know what they're going to get after year 5. So on the left-hand side here, we show that their lifetime income is going to be $23,784. They can start taking that out at age 71. And then you're also going to see on this one what the projected index crediting rates are going to be. Now, when it comes to income products, the caps and the par rates are lower because it is not an accumulation product. That's not what it's for. It is to build your client's income as high as they can get it, so that way they have a higher income payout when they're ready for retirement or whenever they're ready for income. So you're not going to get the best of both. You're not going to get really high caps, really high par rates, and rider. You're not going to get both of those at the same time. So the income products are going to have lower caps, lower par rates. On this one, you could see they do have some years where it's 7.13% credited. There are some 0 years that is going to happen. But as we say, 0 is your hero. You're not going into your principal. You're not losing any money. So it's better for 0 than to actually go down and lose your money, go down into your principal. But there are some good years as well. In year 5, they have 8.2%, bringing up their accumulation value to $215,732. On the right side of that, you will see their income base in year 6 grew to $283,142 after 5 years. So you will see that there. And then on the far right, you will see the death benefit of $201,097. And also they do have an impairment multiplier there that is available as well. But the death benefit is always going to be the accumulation value as well, so please keep that in mind. So these are guaranteed income riders. That means that you can guarantee when you run these numbers, or we run these numbers for you, you can go back to your client and guarantee them that they are going to get this income, annual income payment for the rest of their life. It's not going to change. It's not going to go down. It doesn't matter how the annuity performs. It's locked in at that specific amount, $23,784 for the rest of their life. Even if the accumulation value, bucket number 1, goes down to 0, they are still going to get this. It's not going to change. And then we can go over to the next slide. And I'm going to get it over to RJ on this. He's going to go over accumulation products on the annuity side.
Yeah, great. Thanks, Ashley. So before I get into the product offerings, accumulation annuity products are effective ways for your clients to help mitigate risk across investable and retirement assets. They're also great ways for those who are looking to protect legacy funds to otherwise protect those funds while still being able to secure an opportunity for growth within those contracts. I think first and foremost, I think we need to first understand what is the accumulation period of these contracts. So the accumulation period is a time period in which the investor can build savings and value to their investment account with the intention of having a nest egg or retirement. As the name implies, the money in your account value is the investment capital that accumulates over the time of the contract. The length of the accumulation period may vary on the account or the type of accumulation-driven contract. The first stage of an annuity with an accumulation period is the stage of which you have to grow it. Annuities with accumulation typically have 2 key benefits. First of all, your contributions have time for growth and otherwise protection. They provide potential opportunity for increasing value over the years. You can also continue contributing to these products. The time can also help compound the growth of your contributions. Any interest earnings and additions will also be protected. Number 2 is that you do have certain tax advantages on your earnings. A deferred annuity, whether it's fixed or variable, gives you the potential for tax-deferred growth. The benefit of tax deferral means that potential earnings can grow faster based on the yearly tax earnings and accumulation of the indices selected. So a couple of different ways that these accumulation type products may differentiate. So first we have immediate annuities. These basically would have no accumulation period. They start in the first year. They have guaranteed monthly, annual, or quarterly payments. The deferred annuities, which are your typical FIAs that we're going to predominantly talk about here today, have an accumulation period maybe of 5, 7, or 10 years. They can give you a long period of time to grow with the advantage of compound earnings and also tax deferral. And then we offer fixed annuities. These can be offered in a couple different ways: in a fixed index and in a fixed annuity contract, which would be a fixed rate annual policy year guaranteed interest contract, or a multi-year guaranteed annuity. Sometimes you'll hear them referred to as like a CD alternative annuity. That is a defined fixed interest rate for the longevity of the contract. So typically we see those mostly offered within 3 or 5 year contract periods. We also see 7 years. Usually beyond that, it's not too advantageous in relation to the rates, but if you have a client that's looking to set aside funds that maybe has low risk adversity, those types of contracts can be a great way to provide them with guaranteed growth while maybe, understanding the market conditions at a later time to decide what they maybe want to do with those funds. So if we could move on to the next slide, please. So the first product that we are presenting as a growth accumulation focused product is the Equitrust Market 10 bonus product. So we typically are going to utilize this product if it's a flexible premium option. One of the reasons why we like this product in order to kind of get the contract jump started and accumulating is it is unique in the position that it actually bonuses for the first 5 years of contributions, which is unique. They also do have, as you can see by the slide, a variance of different index allocation options. We typically have producers that appreciate most popularly the indices that have the high par rates, which they offer a variance of. Another reason why I like this product is because it offers a variance of bailout features. So if you have a client that is otherwise uncertain of the longevity, or just having trouble with the concept of access to funds, this is a great product option because it offers a variance of ways they can get their money back without having to pay surrender charges. It has it has an ROP feature, which is on every contract, no charge for that feature. So at any time, the client can surrender that contract. Now they only get back their principal base, but at any time they can surrender the contract free of surrender. It also has a nursing home confinement rider, which means that if any time the annuitant is confined to a qualified care facility, they do have the ability to surrender that contract free of surrender. Also, a terminal illness rider, which is along the same lines, which would be interpreted as 12 months or less of life expectancy. So if we can move on. So here is a table graph of a couple of the most predominant indices that typically we illustrate this. So this is a blend of the 2 high par rate strategies. So as you can see here, the client secures that interest earning in the down years. They're achieving a 0. There is no fee base on this contract, which at any time, I think if you work with any of us in the annuity division, I mean, we're all big proponents of, the absolute 0 concept, which means that in a market downturn, unless otherwise specified with an income rider or some other rider fee may, the client may appreciate. The ultimate downside protection will always be featured on the contracts that we'll propose. So in an ultimate market downturn or a recessionary period environment, the worst your clients is ever going to return is a 0. So if we could move on to the next product. So obviously, if you've been around Levinson for any period of time, we are big proponents of the SILAC product portfolio and their options. They have quite a few different variations of accumulation protection based products. Most recently, they did add, as of last year, what they refer to as their elevation rider. This is a principal-based bonus enhancement rider. Also secures a enhancement death benefit provision and does feature an enhanced withdrawal feature. Now, the really unique thing about this rider that they've added onto their products is it does have a spread fee on it based on whether the client were to elect the elevation or the elevation plus rider. But that fee is only charged if the contract credits. So I believe the elevation plus is 125 spread. The straight elevation rider is a 1% spread. So in other words, that means that if the market were to take a downturn and your client wasn't to receive any interest crediting that year, that product wouldn't result in a negative return still for that year because they only charge if the contract credits that year. I know that these are all premium-based bonus figures. Now, some of these premium bonuses do vary amongst states. I know that, obviously we do a lot of work within the state of Florida with our advisors. The Teton Bonus 10 premium base bonus on this product for the state of Florida is actually higher than most of the other standard states, which is pretty unique. That is a 9% premium base bonus, which results in a total premium base bonus on their 10-year deferred contract of 14%. So pretty robust way to kind of jumpstart the accumulation-driven opportunity within that contract. So we can move on. So as I alluded to before, these contracts are really great accumulation-driven contracts. Now, what is illustrated here is the Teton Bonus 10 product. That's because it features the elevation, and I wanted to be able to show a couple additional features on this. If you're looking for a non-bonus product, typically within the SILAC portfolio, we'll utilize Denali. Offers a little bit better rates. Obviously, there's give and take the bonus contracts if you're familiar with most annuities. So typically with most of the bonus contracts, you're going to get a little bit less growth opportunity in terms of your rates. In our opinion, I think SILAC's rates, although even within their bonus contracts, are still really sustainable. We also obviously pay attention to rate history. We have seen a fair amount of carriers aggressively increasing their rates over the past couple of years because of this interest rate environment, and because they obviously know that this is an advantageous annuity environment with a little bit of the market insecurity going on. So they kind of give a great balance of that. They do have a fair amount of par rate strategies on this particular product. I think the S&P par rate strategy is 45%. The NASDAQ generation strategy, which I've also featured here, is 157 par rate strategy. That's one of the highest returning strategies that I believe we have available within our market selections. So on this particular product, it is That particular strategy is showing an index return average of 9.91%, with a high yield return rate of 12.86. So even though the client's getting a pretty robust bonus with this contract, it's still offering a pretty high accumulation opportunity for the client. The other aspect of that elevation rider that I wanted to show, which is, which I got into a little bit with the Equitrust option, is accessibility of funds. That is probably one of the most asked questions amongst our producers and their clients. So with that elevation bonus, as you can see within the free withdrawal percentage column on these illustrations, they feature a vesting withdrawal bonus, which I know there's a fair amount of products out there that maybe have a doubler. If you don't access the prior year, you can access up to 20%. With this particular SILAC elevation rider, they will grant up to 50% free withdrawal as long as the client hasn't accessed funds in the previous year. So creates a little bit more of a robust bailout for the client if they need access to emergency funds. So if we could move on to the next slide, please. So now I'll pass it off to Josh Hoffman. He's going to speak a little bit about linked benefit products and also some withdrawal enhancements now.
Hi. I just want to speak a little bit about using annuities for LTC. And annuities are a great option for LTC because they allow the person to get their money back if they don't need LTC. Also, the underwriting is also many times much easier than getting a traditional LTC policy. And if you can move to the next slide, please. Now, one thing to keep in mind is there's a few different ways to get LTC from annuities. And which one you choose depends on a lot of different factors. But I want to go over what we call true LTC annuities first. And what I mean by a true LTC annuity is an annuity which complies with the Internal Revenue Guidelines to give tax-free benefits when the person needs LTC, when the person needs long-term care. And basically the way these products generally work is the benefits are calculated as a percentage of the balance. So in other words, for example, they may give 2% of your balance when you need long-term care, but rather than paying it for 50 months, they would pay it for 72 months. So you have a good chance to get actually a good deal more than what was in your annuity. And if you're using it for long-term care, the gain would not be taxable. And the other advantage is that with many of them, as I said, the payments will continue after you hit zero. Now, the thing about true LTC annuities is you have to really know what type of money the person has, because true LTC annuities only accept non-qualified money. They won't accept IRAs or 401ks. And that has to do with the fact that the proceeds are tax-free, and the government unqualified money will not get the tax break on both ends of the transaction. Now, income rider doublers, you can use after-tax money. These particular ones do not qualify under the Internal Revenue Code as long-term care, but the positive side of that is that you can put qualified money in them, which you can't with true LTC riders. And what most of them will do, most of them are similar to what Ashley was talking about, they're income riders. However, the difference between these and some of the other income riders is these income riders will double if the person needs long-term care. Okay. Kate, next slide, please, Andrew. Now, I want to talk a little about one of our more popular ones, Global Atlantic 4Care. Now, this is a fixed annuity, so it's for more conservative investors. And the fixed rate is currently 4.5% to 5%, depending on the size of the deposit. The fixed rate you get varies by how much money you deposit. Now, the thing is that the 4.5% or 5% is not guaranteed forever. The company renews each year based on their decision, but the minimum they could pay you is 1%. And the way underwriting works on these, and these are underwritten, is that the client answers about 10 underwriting questions in a telephone interview. The company also gets a HIPAA form, just like they would with a life insurance policy, and that allows the carrier to order doctor's reports and prescription drug histories. And then based on that underwriting, one of three things would happen. The client, if they're perfectly healthy, nothing wrong with them, they could get 3 times their balance as long-term care. The other possibility is if they have some health problems, but they're not bad enough for a decline, they may get 2 times their balance in long-term care. And of course, a third, if they do have a major problem, they could be declined for the LTC benefit. If you can move to the next slide, Andrew. And the benefit calculation, I just want to go over that quickly. If the person's perfectly healthy and they get 3 times their benefit, what the company will do is take whatever their balance is at the time they're claiming LTC and divide it by 24 months. And so, as an example, let's say they had $100,000. If they had $100,000 at the time of their need for long-term care, the company would divide that by 24 months and calculate that their monthly benefit is $4,167. But rather than paying that $4,167 for 24 months, they would actually pay it for 72 months. They would pay it for the first 24 until your balance was depleted, but then they would continue to pay it for an additional 48 if you need it for an additional 48 months out of the company funds. And the 2 times option works the same way. If the person got approved for 2 times option, they would take the balance and divide it by 36 months. So in this case, same scenario, the person had 100,000, the benefit would be 100,000 divided by 36, which is $2,777. But rather than paying that $2,077 for 3 years just to complete the policy, if the person still needs nursing home care or home health care after those 3 years, the company would continue to pay out of company funds for another 3 years. If you move to the next slide, Andrew. And I kind of ran this quote as an example of a 71-year-old woman who needs long-term care when she's 86 years old. So what this is showing is that she could get $4,262 a month, and that benefit would be paid for 72 months. So in other words, they would pay off her entire balance, and then once the balance was paid off, they would continue to pay. Okay, if you go to the next slide, Andrew. Equitrust Bridge is another long-term care policy that works a little bit differently. This is an indexed annuity. Now, as I said, 4Care is a fixed annuity. So with 4Care, in all likelihood, you're going to get 5% or less a year, whatever the company determines the interest rate to be. With Equitrust Bridge, because it's indexed, you have an opportunity to get much better returns because it's index performance. Now, Equitrust Bridge is a little more geared towards somebody who might be a little bit younger. And the reason I say this is because they have a 5-year vesting on the benefit. So in other words, the person has to have the policy for 5 years with Equitrust Bridge before they can get the whole benefit. But it also does have some unique features. They have a wellness feature where if you participate in the company's wellness program, they will increase your benefit. And the great thing about the long-term care rider with them, just like ForCare, they base a claim on the inability to do 2 ADLs. So whether you want to go to a nursing home or get home health care, it's going to pay either way. You can choose your initial LTC amount, and they both do this. There's no receipts required. It's what's called an indemnity policy. So as long as you have an issue where you can't do 2 ADLs, it's going to pay. You don't have to show them your bills or receipts. You can spend the money how you want to spend it. And as I said, the wellness program is unique to them. And the wellness program actually is a program which has measurable outcomes. And if the person does well on the measurable outcomes, they will get additional coverage on their long-term care rider. Okay. You want to move to the next slide, Andrew? And again, the advantages of Equitrust Bridge over ForCare would be the greater opportunity for growth and the wellness crediting program, where if you participate in their wellness program, you will get a larger benefit. The downside, I guess, is a 5-year vesting. And as I said before, this is probably more geared toward younger people. I would probably recommend this for people maybe in their 50s or 60s who are healthy. For clients in their 70s, you'd probably be better off with ForCare, because ForCare will pay the full benefit from the first day or after a 90-day waiting period. It's not a 5-year vesting. You want to move to the next slide, Andrew? Okay, and I just want to go over how Bridge works, because it's a little bit different than how ForCare works. It provides 60 months or 5 years of long-term care benefit. And the amount of benefit is determined on a multiplier. So it's kind of similar to ForCare in that way. The multiplier, what's a little different than ForCare, is that Equitrust Bridge has a guaranteed issue option. And the way that works is the multiplier of how much of your balance you're going to get based on your health is going to be between 110 and 300%. And obviously people in the guaranteed issue type of health are more likely to be closer to that 110%. Now, the good news is even if you got that 110, the base benefit does increase by 2% every year for 20 years. So if you do stay healthy enough not to need long-term care, your benefit would still increase over time. And again, it does also have the wellness program, which will also increase your benefits over time. And what they're going to do is take that multiple between 110 and 300 and multiply it by your balance, and then divide it by 60 months to come up with your benefit. The annuity account will keep growing until you start using the benefits, and that's one of the great things about this. And with traditional long-term care policies, they're kind of like car insurance. You pay till you get in an accident. With this, you're actually saving your own money. And with Equitrust, you're saving it at market rates. And, if you have a situation where you don't need long-term care and you pass away without needing long-term care, that money will go to your beneficiary. And that is one of the great things about this policy. Also, as I said before, the fact that it is indemnity, so no receipts are required. They're not telling you how to spend the money. If you want a family member to take care of you, if you want a home health care nurse, if you want to go to a nursing home, it's up to you. They're just giving you the money and you spend it, or your caretaker spends it how they please. Okay, Andrew, you want to move to the next slide? And I just wanted to give this example of the ForCare for this client. And this is, I don't want to get crazy with it. This is kind of typically what would happen with a client. So with this particular client, 71-year-old woman puts in $100,000, and she gets approved for 150% multiplier on the benefit. So, let's say she needs long-term care at age 86. At age 86, it's going to pay $4,974 a month for 5 years. So it's paying almost $5,000 a month for 5 years. So from her $100,000 investment, if she needs long-term care, it's actually going to provide about $300,000 in long-term care dollars, and that $200,000 of gain is tax-free because this is a qualified long-term care policy. You want to move to the next slide, Andrew? Okay, another way to provide long-term care is an income rider doubler, and it's kind of just what it sounds like. The income rider doubler will double the income if the person can't do 2 activities of daily living or is confined to a nursing home. And there are a lot of differences between ADL doublers and true long-term care policies. And one where ADL doublers do have an advantage is the fact they can take qualified money because they're not IRS qualified. So, I guess the downside is you will pay taxes on the gain, and you will pay taxes on all of withdrawals if it's qualified. But the upside is you do have a way of using qualified dollars to provide long-term care. And I guess the other big difference is when you get a true long-term care policy, the amount of long-term care benefits you get is guaranteed. Now, with a long-term care doubler, it's not, because the way a long-term care doubler works is they're doubling the income from the income rider, and they will only double it as long as your income base, which I actually spoke about before, has a positive value. Once that income base drops to zero, your income itself will not stop, but it will stop doubling. They'll go back to your previous income of half the amount. If you can move to the next slide, Andrew. And there is no, one of the other upsides of a long-term care rider is there's no underwriting like there is for true long-term care policies. Anybody, regardless of their health, can add a long-term care doubler to their annuity. However, just to be clear, there is a little bit of underwriting on the back end, because if the person could not perform all 6 activities of daily living as specified by the government at the time of issue, the company will not double the income rider. So that's, it's kind of a low underwriting bar. You have to be able to do all of your activities of daily living without assistance. And again, income rider doublers are tied to income. So again, if the person starts income and then needs a doubler 10 years down the road, there's a good chance that income rider balance might be 0 and it may not double in that situation either. So that's where true LTC policies do have an advantage, because they are guaranteeing a number of years of long-term care payments. If you can move to the next slide, Andrew. And I just wanted to kind of give you this. This is the same illustration I used for the other two, which is a 71-year-old woman putting in $100,000 and taking income at age 86, or actually needing long-term care at age 86. So what happens, and I kind of did this a little bit backwards just to show you the LTC at an early age, is her normal income would have been $23,622. But because she's in a situation where she can't perform 2 activities of daily living, it doubled to $47,245. Now, one thing you might notice about this illustration is the $47,245 is only being paid for 3 years, not for 5. And that kind of goes back to what I was saying before about the doubling stopping when the income base equals 0. Now, it doesn't stop the income altogether. As you can see, in year 4, it drops from 47 to 23, and this person would be guaranteed the $23,000 income for as long as they live. So, there are pluses and minuses to both. The plus of the income rider doublers is that there's basically no underwriting for them, and they take qualified money. So a lot of it comes down to what kind of money your client has and what kind of health they're in. Okay, if you can move to the next slide, Andrew. And that brings me to the next part about what kind of questions you have to ask when deciding between true LTC or a rider. The first big one is, are the funds qualified or non-qualified? If the funds are qualified, the income rider doubler is really your only choice because the true LTC policies will not take qualified money. The client's health, again, income rider doublers are not underwritten. They won't double. You don't want to do it for everybody because they won't double. The person can't do their ADLs, but assuming a person can do all their activities of daily living, they qualify for a doubler. Now, true long-term care policies do require underwriting, so they would be more for your healthier clients. Again, investment style is another one. Usually income rider doublers are indexed annuities, and Equitrust Bridge is also an indexed annuity. So they're probably for more aggressive investors. If your client is extremely conservative, you may want to look at Forcare because Forcare does pay a fixed interest rate. And the last one is income needs. True long-term care policies really aren't designed to provide income. They're designed to provide long-term care. So they're not really going to pay income or do great accumulation likely if the person, if that's what the person is looking for. They're really more designed for people looking for long-term care. Now, the income riders are on regular indexed annuities. So they could be for a person who's looking for retirement income but concerned that they might need long-term care. So it's kind of a little bit of a different thought process. The person saying, I need 20,000 retirement income, but I want to be covered if I need long-term care, would be more for the income rider. And a person says, I want to have something akin to a long-term care policy, but I don't want to put in thousands of dollars in premium and not get them back if I never need long-term care. That person would be more of a person for the true long-term care policy. And that's what I have on long-term care with annuities, and I'm going to throw it back to Bill right now.
All right, Josh, great stuff. And I know real fast, it's a little over the hour. I apologize for that, but there's so many moving parts, as you know, and we just kind of dipped our toe in the water. We can go on for a half a day. But again, I said it probably 4 times. Just pick up the phone and reach out anytime. We're here for you. I have a few slides here. I'm going to wrap this up in about 3 to 4 minutes, and then I have my question of the day that we touched on, and then whoever answers first and correctly wins the new Fire HD 8 tablet that just came in. So real fast, what I want to show you, we have some great concepts. I already see some emails coming in with questions. It's funny how that works, right? People can't wait to get started. Maybe they have a guy, they have a girl. So getting started, you're going to see our thank you email come in today's inbox by 8 p.m. the latest. What you're going to see is on our home page, you just hover over annuities. You'll see that red rectangle there. And then on the bottom, on the right-hand side, it will say iGenius Annuity Training. That's where everything is at your fingertips, including our discounted E&O policy. That's only available for Levinson agents. Gives you a chance to save a few bucks there. And then the next slide is what makes us different. Why Levinson Annuity Department, right, over all the others. So this is a complete listing of what's unique about us. On top of this, what we're adding, in fact, we're launching at the Expo, we're going to have the first ever AI-powered chatbot sitting on our website. What that means is you can ask this robot any question that you come up with that has to do with life or annuities, supplemental products, and this robot scrapes our entire website, gives you the answer in real-time fashion. The robot's name is Billy the Bot. We're going to be launching that, like I said, April 12th at the Expo. And then we're launching the first ever iPipeline. Think about this. It's an iGo e-application just for annuities. We're the pilot agency, so that's also coming out this year. Very excited about that. And as a Levinson annuity agent, it'll be a first for you as well and a leg up versus your competitors. Let's keep moving. What we always talk about is our social media posts, getting the word out. We handpick 2 top performing posts every week, depending on the topic. And this is what came up for annuities. So as you can see, very simple. The first one, never outlive your money. The one on the right is just about educating your consumer, right? And that doesn't matter if it's life or annuity. These both perform great with 20, 30 comments, 50 to 100 likes. And again, don't reinvent the wheel, just change a few spokes. That's just some great examples of what other agencies are doing to move the needle in the social media space. The next slide here is my podcast, Bill Levinson Experience. Every month we have a new guest speaker. We have some great annuity guest speakers. They're stand-alone annuity trainings you should check out. We have our consultant, Chris, who did a couple that are great. Also, bottom left corner is Manhattan Life, where we talk about life and annuities. The middle is Tony Robbins' right-hand man, Mike Savage. And then on the top there is the last episode we recorded here in the conference room with one of our top life and annuity agencies. And then Mike Savage, again, is on the left-hand side in that picture. That's a great episode. And it's all about, yes, industry-related, moving the needle, and personal strategies, right? How to stay in that great mindset day in and day out, even when things aren't going so great. So that's what that episode is about. Check it out when you can. The next slide here, and I'm almost done. One more slide after this, is our live training events, which is what you're on right now. The reason why I wanted to highlight this, even though we're running late, is because these are some great episodes that are coming up, and I'll tell you why. The first one, and this is the blue box, Corebridge is real hot right now on the annuity side and the life side. So we're going to have our life VP, our annuity VP, all on one hour call on the 14th. Just below that, we handpick the top final expense products and platforms that are complementary to you, so you can start entertaining, marketing, selling to the senior market space. Just under that is the latest instant decision IUL from Americo on the 28th. Just below that, this is a great 101 webinar, how to do business with Levinson. And if you're new, if you've been doing this for 28 and a half years, it doesn't matter. This is everything from A to Z working with us. On the bottom, this is another big one. The reason why Emeritus always had a clear-cut career channel and then the brokerage channel. And on the brokerage side, we were very limited on products. We only had a term in IUL with living benefits. Guess what? Starting on the 31st of March, okay, we're going to launch it on April 25th. You have access to all the products from Emeritus, including DI and whole life, everything. Okay, so one channel's not too happy about that, but our agents get the best of both worlds. Make sure you're on that call. My last slide here and my question of the day, and you got to answer first. Get your little fingers on the keyboard, and you got to be quick. What is the maximum amount of years you can double an income payment? So I know Josh touched on this, so did Ashley. You tell me the maximum amount of years you can double an income payment. Okay, by the way, that's not product or carrier specific. It's a general answer that they both spoke about a few times, as a matter of fact. While you're answering first and correctly, I'm going to move over to the left-hand side. This is our Positive Tuesday quote of the week. We learn the way on the way. Trust the process, right? You're never going to know what side is up until you jump in, look around, figure it out. But the point is, you got to jump in, put your right foot on the gas pedal, right? Try new things, try new strategies. If you've never sold annuities before, now you know enough to be dangerous, right? Bring it up, and then we're here to help you, right? As soon as you hit a brick wall, pick up the phone. We'll do everything but speak to your client. I said it 3.5 times now, okay? So anyway, jump in head first and trust the process. Andrew's going to tell us who answered first and correctly for our question of the day. Andrew?
First correct is Melissa C. Melissa C.
Melissa C. The answer is 5 years. That's 5 years. With that said, I want to really, truly thank each and every one of you for sitting with us this last 80 minutes. Okay, I know it's a long time. I hope it was worth it. I hope you picked up a nugget or two. Thank you again. Keep your eyes peeled for the thank you email. We'll see you next week on the live training event Thursday. Have a great rest of the week, great selling, and thanks again, everyone.